schemes. But we have seen actually over the last several months that the allocation, for instance, to crypto assets has increased by over 300%.
Hi and welcome to the Financial Fox, investing and innovation ideas with a twist. I'm your host, Steffy P, and in this episode, to discuss investment, finance and cryptocurrency, I have Swen Werner, Managing Director at State Street, one of the world's leading providers of financial services to institutional investors and one of the first investment banks to embrace cryptocurrencies.
It's really looking at blockchain and digital assets and having a firm belief that this is an irreversible trend. It's here to stay and will impact the financial industry over the years to come.
So it's going to be pretty exciting. But before we go into the episode, I want to talk about my new crypto web domain name, financialfox.crypto. I got it from Unstoppable Domains, which is creating a new generation web domains, which are actually domain name on a blockchain. So when you buy them once, they are yours forever and you don't have to worry about renewable fees anymore. And they are decentralized, so no one can take them down or hack your data. And also because they are effectively NFTs, you can trade them and make money once the decentralized web will be taking over the internet. The cool things that I really like is that they make crypto payments very easy. So what you do, you basically add your crypto wallet address to the crypto domain address and forget about it. So when you need to get paid, you just give your web domain address and voila, the payment is in your wallet. How cool is that? So if you're interested, you can go to Unstoppable Domain using the link in the description below, which will help to support our channel. And if you want to do a little bit more to help us because you like the content we are doing, you can make a donation in Ethereum, Bitcoin, or USDC to financialfox.crypto, and that will be super appreciated. Hi Sven, it is great to have you on the show.
Thank you very much for the invitation. Really looking forward to our discussion.
All right, so shall we maybe start with a background on State Street and also how did you got involved with the organization?
Yep. So we are a global custodian, actually, I think the second oldest bank in the US, but that's not all we do. So we have a large asset management arm, then obviously providing the safekeeping and administration services to institutional asset managers. And then very importantly, I think, providing a number of revenue enhancing or risk mitigation services. That could be FX, could be securities lending, it could be research services. So it's quite important that an institutional investor, they can invest in assets, hold them safely, get reporting and get risk control over that. And we're doing, in a sense, all of that. Personally, in terms of getting involved in State Street was really from the perspective of significant market change. So several years ago, the European market went through a rollout of a new platform called Target 2 Securities, which was looking to replace security settlement applications that were implemented and running according to national barriers. So each market basically had their own technology solution. And the European Central Bank stepped in and wanted to provide a single platform that would be outsourced and shared amongst all of these participants. And for us, we provide access for institutional investors to way over 100 markets. So market access, efficiency in that access is quite important. And so I joined State Street, really helping shaping up the business model that would be required to think of a new access model into Europe.
And that's very exciting. And also we have this concept of digitalizing a bank. And, picking up on the State Street has made this, quite significant step to expanding the bank services and product with a new digital division. So I would like you to comment on the strategy and on the objective to this for this decision.
Yeah, so it's our latest, newest business division. So thank you for bringing it up. And this is quite exciting to be actually part of that journey. It's really looking at blockchain and digital assets and having a firm belief that this is an irreversible trend. It's here to stay and will impact the financial industry over the years to come. And so we need to be ready for this, where investors who today invest in the traditional ways would increasingly look to make investment through the blockchain and digital channels. And we have to get ready to be able to service these new asset classes. But at the same time, you also want to take what's good about the digitized investment scheme from pre-trade, middle office, post-trade, all of these functions, and really try to enhance and the core of what you have today and make it more efficient. So State Street Digital really is about both. It is the servicing the new, but also taking new technologies to make, if you want, what you have today more efficient and more robust.
Exactly. I want you to expand on that. How blockchain technology makes finance and the financial market more efficient?
Yeah, so there are many potential ways. And obviously, we are talking a little bit about a future anticipation. So the vast majority of the portfolios that we service are done through traditional schemes. But we have seen actually over the last several months that the allocation, for instance, to crypto assets has increased by over 300%. And so it's coming, it's growing at an enormous rate. In some instances, obviously, from a smaller base, depending on the jurisdiction. So you have, on the one hand side, a new asset class that has certain features that is different to today. So that is in itself an efficiency and a revenue generation opportunity. So, for example, personally, I'm quite intrigued by the concept of stablecoins. So today, when you have a bank account, you have your cash in your bank account, and so your interest earning, that you can earn interest from that cash, and the ability to pay is linked to that single location. If you have a stable coin, you can decouple this. These are now two separate decisions. I could have a stable coin holding this in my wallet, but the fiat cash sitting at another bank where interest is generated. And so suddenly the ability to pay and your ability to earn interest are two separate decisions, and they could happen at different places. So that ability to deconstruct really the value chain is something that we could not have done previously. And then obviously, if you think about today's financial system, is highly intermediated. There are centralized infrastructures. So with blockchain, there's this strong hope that we could rethink a little bit the economic exchange more towards a peer-to-peer network with less reconciliation and single shared of truth. And that's quite important, actually, to everything we're doing. We are data scrubbing that we get in. We are comparing it to another data source and trying to make sure we operate on clean, tested data. And with blockchain, in a way, that problem you can almost define away, because you have now, we're all operating within the same environment, and therefore, in theory, we would no longer have these disputes about what is the state of my transaction. And so that in itself should really power efficiency for years to come. And finally, whether that's through blockchain or from other means, is I think really this, and we all have that experience from our day-to-day life, where we buy plane tickets through your mobile phone, etc. You click, you get an immediate response, you know what's going on. And that kind of experiments is increasingly expected to be brought into the financial system. And again, today, particularly in the custody world, there are different ways of looking at the world. You have a trader who has a traded position. You have a back office who looks at the world from a settled position, which may be different because you may have bought something, but it hasn't settled yet, so there's a mismatch. Then you have an investment book of records, you have middle office, so we are all taking a different cut of the world, but then we need to reconcile and make sure it all adds up together. And that is necessary, there's reasons for that, but there surely is a better way of doing that. And that's really what the promise of blockchain is about, that you cut through this and you collapse trading view, settlement view, investment book of records view, all into one single, this is the truth. And from that should be one process, only one time to record the asset, and therefore avoid these duplicated reconciliation processes.
I think you highlighted everything very well. There is one thing that I'm always thinking about. I mean, markets are trading still between hours because they're still, linked to the fact that there is a physical organization, there is a physical stock exchange that is trading, but perhaps maybe we could go to a 24/7 like crypto.
Maybe. Obviously, there are multiple reasons why we do what we do today. So first is time zones, right? So if you sit in, APAC and you want to trade US securities, you have a very short window when actually your counterparts are in the office. So is this going away? Question mark. Then also purely from a, sounds super boring, but from an accounting perspective, you need to today define a business day. You open your books, you close it, you know what my risk position is. If we are going really into 24/7, would I now need to really calculate my P&L and my process in a basically an intraday basis? So there's another final thing that is really being debated quite a bit now increasingly. So we have over the years in the traditional finance side reduced settlement cycles from T+5 to T+3 to T+2, and maybe we're going to T+1. That's all possible. But going from T+1 or higher to T+0, T+instant really breaks everything, because you now need to start thinking about pre-funding requirements. The fact that today you have a settlement cycle is also, in a sense, you could argue, a driver of efficiency, because you do not need to pre-fund everything. So that puts a lot of strain on your back office, on your matching systems, etc. That all the information, everything you need to do happens in a very short, quickly amount of time. So I don't know how quickly and how realistic it is that we really get into 24/7 trading anytime soon. But on the flip side, this is always for me the important. If you want to, we would now have the possibility to do that. And I think that's the difference. So would we, if we were to start from scratch today again, would we design the financial world like it is today? Probably not. But there are good reasons why, for instance, I think 24/7 trading may not be attractive. And you have seen this in the past, right? Exchanges expanded trading hours, and then there was very thin liquidity, because at the end of the day, I would argue we are human beings and don't want to trade 24/7. But who knows?
You raise a good point, because sometimes, even that gap time gives fund managers some time to think about it, and also to investors to say, maybe I need to, is that the right things to do? Maybe I should think a little bit more. And if you don't have that time, you might just do things that you wouldn't have done without. So, it might be actually better like that. Well, anyway, DeFi. That as technology in DeFi has kind of revolutionized many things, market making and, all different opportunity. You mentioned before stable coin with APY, all different kind of things. Do you see DeFi taking over the centralized finance, or perhaps both collaborate? And where also DeFi gives an advantage?
Yeah. So for me, it's one of the most exciting topics to think about. And really from the perspective, and I mentioned this earlier, we've seen certain types of clients starting to invest a little bit in crypto. And if you do this, if you want to invest in crypto, you hold crypto, you have to think about DeFi and staking in the same way you have to think about trading. And I think that is in itself a big difference between the traditional, if you want, custody world and the future world. Today I have trading here, I have custody there. These are separate functions. With crypto and DeFi, it's becoming part of the same equation. If you want to be able to sweat your assets. So I think it's important for institutional players like ourselves to think about the concept from that perspective. The second question for me is then, will DeFi, if you want, to remain focused on crypto and stablecoin, or would it start to evolve also in security tokens? And as soon as you say, or your hypothesis is yes, then regulation will come along. And that's something that is a bit untested at the moment, how this would really look like. Because if you think about what DeFi does, it's just like replicating a lot of the functions that an intermediary like State Street performs today, without an intermediary. So, but if you bring regulated assets within, you bring oversight requirements, which is quite important. So it's not for me so much a question about one thing overtaking the other. It's more a question of to what extent can that market grow and become systemic? Because as soon as a regulator sees a systemic market to appear, the question will come around the appropriate level of regulation. So some markets like the EU have now proposed, for instance, that if in future somebody would create a DeFi protocol, there would have to be a white paper, and exchanges would only be allowed to give access to these constructs if that white paper has been published in the first place. So I think what regulators will increasingly try to do is control a little bit the distribution side of things. You can create these kind of protocols, but if you allow particular retail money flowing into it, the people that do this have to perform a certain gatekeeping or due diligence function. But I think for me, what's very important is it's crypto and DeFi. They are a continuation of a trend which we see anyway in the financial industry, which is a stronger emphasis on peer-to-peer activity. So in State Street, even irrespective of digital assets, we have been launching peer-to-peer repo trading solutions, for instance, where an asset manager can trade against another asset manager without having to be intermediated by a broker dealer. And DeFi just takes this and now says, well, that's the standard, where today is, if you want, the exception could become the standard. I think that's very important for us. We service buy-side clients, if you want, the institutional investors. If they're looking for a different way of economic exchange, and we may call that now DeFi, I think that's a very perfect value proposition. So that I find quite interesting. Final thing I would say, however, again, for instance, if you take securities finance today, global custodians like States will provide agency lending, so an asset manager can lend out security through us. And typically agent lenders provide, they collect collateral, but we also provide an indemnity. If something goes wrong, you basically make up for it. DeFi has the collateral, but it doesn't have the indemnity. And that is something we have to see whether institutional money really wants to put large bets in a construct that has, at least if I look at this like objectively, a little bit less, insurance policy attached to this than what they're used to in the traditional securities finance market. So I think has to be tested. How big can this actually grow before the reasons why, for instance, we today operate for indemnities become, a question again.
So let's talk a bit about your clients, how you are serving them, and how this change in technology and requirement also from your client has changed your services.
Yeah, so it's in many aspects. So what we have seen, for instance, and we have been speaking about this publicly, where we started to provide, for instance, administration services for crypto funds, exchange traded notes, or some proposed ETFs in the US that are still pending regulatory approval. And what we will have to do, and in the European markets we provide, we have to access crypto custodians, get their transaction data, balance data, so that we can calculate a NAV. In the traditional asset management space, a lot of that transaction flow happens through ISO standards, through SWIFT protocols, etc. We know how to do that and can set this up very quickly. The crypto space doesn't really use SWIFT and has their own API connectivities that are constantly changing, and they have their own take on it. So we had to build, for instance, an infrastructure that allows us to go into all of these places without using a SWIFT network. And that's quite important, that at least initially there's additional complexity coming from the digital asset space, because there's less standardization than what we are used to in the traditional capital markets side. Then these markets, we discussed this earlier, are a bit more 24/7. So today, when I'm holding securities, I get an end of day statement. So there's a very clear, well laid out timeline how you operate during the day. But here, sometimes information come at midnight, and so it doesn't fit neatly into your business day, and you have to think about how you allocate your resources and timing. And then going forward, it's really we have already done experiments around tokenizing funds, working with programmability for FX collateral. So where suddenly you have you need a different engagement model where today an investor would buy securities that are issued in DTC and we would hold them in custody. And now they could come in a tokenized form. There needs to be a wallet address. So all of that workflow is very, very different, and we have to factor this in. And I'm always personally thinking it's a bit like open heart surgery, right? You cannot allow things to fall over or make mistakes. So you have to allow for that change at a time when you're servicing a large transaction volume. So that's really what we're trying to do, is like adding these components to allow investors coming into some of these new asset markets, but still providing a robust service for the traditional assets, really that bridge between old and new, what we are trying to build out at the moment.
So talking about a new asset, I mean, I would like to spend some time to discuss CBDCs, because so there are two kinds of CBDCs, wholesale CBDCs and retail CBDCs. So what's your take and State Street view on CBDCs? And then we can go a little bit more into details, for instance, on what each country is working on.
Yeah, so we are part of the core mandate for the State Street Digital is to deal with new digital forms of money, and so CBDC is a big part of that space. And as you said, there are different ways of designing it. Could be retail, it could be wholesale, it could also be various forms of hybrid solutions. And really, what we mean by this is in terms of, do you put additional constraints on that assets to make it more cash-like, in which case it's probably more retail, or do you really treat it as a different technology stack for an RTGS account? So today, when we move funds at the US Fed, etc., we access directly the central bank system, and that is typically just used for wholesale payments. So, for instance, the key question is, would a CBDC pay interest, yes or no? If the answer is no, then it's probably going to be appealing for retail investors, probably less so for institutional investors. Or would there be volume limits? So in most cases where CBDCs are being put forward, they somehow limit the total amount of money you can hold in that form. So in which case it's going to be a retail thing. So for us, it's very important. We actually made an investment in a co-founder of a company called Finality, which is looking to create a decentralized payment system, starting in the UK, a few other currencies. And the Bank of England is actually calling this a synthetic CBDC. So in a way, you take cash that sits at a central bank, you create a legal and technology overlay that allows you to, in a status in a non-legalistic way, tokenize that cash, and then you can move funds in a counterparty risk-free asset type around that actually could be used for wholesale payments. And I think for me that at least short-term is sort of the future a little bit, that we are an institutional player. We are interesting, we're monitoring, we're discussing with central banks their plans around CBDC. As you said, a lot of them are probably at the moment looking at the retail side of things. So there's things to learn. And we are at the moment obviously trying to build solutions for wholesale markets, but you can't really wait for CBDC at the moment. So that's why we are working on things like Finality. But that is could change everything in terms of the cash, what I said earlier, the deconstruction of what you mean by cash would have an impact to everything we do, from security settlement, finance, how we manage our balance sheet, how we provide funding for loans and overdrafts. And so it's a critical area to look at. Just maybe one final thing, and I found this quite interesting at the moment. There's a lot of debate now, what is the right way forward on this, particular in areas where it may not be CBDC in terms of the central bank running the entire infrastructure themselves right now, but maybe fintech building something like a stablecoin plus. Yeah. And there's now a debate, what are the right conditions for fintech companies to get access to central bank accounts for that purpose. And that, for instance, for me was quite interesting with Finality. The Bank of England recently announced that they would be changing their rulebook to allow what they call a wholesale pre-funded cash coin or cash token to get access to the RTGS system, subject to complying with a set of regulations. So we had to explain the concept. It required an adjustment to the legal framework, which is now obviously open to everyone. But the key thing is that will be a distributed cash token that is subject to regulation. And I think for me, that is really the key thing at the moment. Stablecoins are very interesting, but again, if they scale up to become systemic, there would be a regulatory expectation that they are regulated. And so we not going to wait until this happens, but build a regulatory compliant solution from the start.
That's very interesting work that you're doing. But coming back to the retail CBDCs, I mean, I can see the advantages for the government, reducing fraud, kind of tracking, tracing and tracking the money. That's much easier than cash. But then, you think about retail CBDCs and how they could pose threats to kind of bank funding. And also we might going to see less deposit with commercial banks. I mean, do you see that kind of like being a problem and perhaps maybe that has to change something in the system completely?
Yeah, so actually this has been modeled. So every central bank is probably well aware that if you had a CBDC, it at least has a chance to increase the risk of what they call a digital bank run. So if today you can, if you want to hold an electronic version of cash, at least in most jurisdictions I'm aware of, you can only, as a non-bank, you can only do this as a retail investor as through commercial bank money. So if you could directly have a liability at the central bank, then you have that crowding out effect. Why would you still maintain balances at your commercial bank if you could have an asset that has less risk at the central bank? So this has been modeled. There are two ways to deal with this. One is interest in terms of what banks have to pay more, so would the competition for interest rates change? And the other question is, would you limit the total amount of CBDC an individual could hold? And that is actually the approach that most central banks seem to be inclined to go. Europe, US is a general theme in order to limit, if you want, that kind of risk that you would have commercial banks a too strong negative impact. And there's a very important reason, because today payments and credit, because of that commercial bank money structure, because of different time zones with different operating hours, because of a correspondent network, cash and credit intermediation go hand in hand. So if you say, I want to take away the deposit, which is the funding base for overdrafts, if you take this away, you also have a negative impact on payments. So that is an issue that hasn't been fully resolved yet. To be honest, in where we at the moment seeing these examples, if the way forward really is to do retail only with a transaction volume limit or a size limit, how much you can hold in total, then I think the impact probably is going to be to the banking sector in terms of the overall deposit base less dramatic. And really the idea would be to say the CBDC should be used as a form of payment and not as a form of investment. And you can structure this obviously by, as I said, interest, volume limits, and many other ways than how you want to do that going forward. And then the final thing is, and this is for me also a bit yet unresolved, do you want to allow for these offline spends, so that if you're not connected through your mobile, that you could give your friend the keys, which also means that the private keys and the real money is actually sitting on your phone. So if I steal your phone, it's like I'm stealing your note from the pocket. And there is a bit of, I think, it's still debate whether central banks really like that idea, sort of that they're creating a network that could create these kind of risks, because obviously today they're not dealing with that segment of the market. So I don't know the answer to that, but at the moment I think there is probably the negative, the downside, at least in the short term, is probably a bit overstated than because regulators are well aware, and there's no desire to use CBDC to cause financial mayhem.
Yeah, obviously, it's kind of like something that we have to watch how it evolves. And there are a few countries, though, they are looking. I mean, the European Central Bank launched an investigation phase, digital euro, to last 24 months. I thought it was quite a long time. I'm not sure when, if they release the CBDCs, they will be, like 4 years ahead, and we don't know even how the blockchain technologies has evolved. Anyway, China looks quite advanced in the experimentation. Do you maybe want to comment on, the Chinese experimentation in the space?
Maybe only so far. For me, this is the most important thing about this example is, what can we learn from what is happening in China, and how is it applicable to Europe or US or sort of more developed markets? And I would argue very little, at least for now. So it's a very retail-driven initiative, which is fine, but also it tries to address an issue that we don't have in Western markets right now, which was that retail merchant payments were mostly processed by non-bank tech firms in China. And so a big part of the creation of that form of money is to make sure that organizations that are not regulated as banks do not perform what is perceived as a banking regulation. But we don't really have that issue. So in that sense, there's not one-on-one transferable, but there's maybe one aspect that is important, which is the banking sector in China, and that particular segment, has not innovated enough and provided a solution. So therefore, payments went from banks into basically these QR code-based online wallet accounts provided by IT companies. So I think that is important for the banking industry more broadly, that even when you mentioned earlier CBDC and why does it take so long, sometimes it's hard to explain, well, why is that payment better? And I'm always saying, well, this is a bit like when we are trying to have a debate before the iPhone was created, whether it's a good idea to have email on your phone. Yeah. I remember, I was very, very happy for many years not checking my email, all time long. But nowadays you can't imagine this, how it would be without it. And in a way, it's a little bit like this, where we have to start, and I think this is a big trend and driver for a lot of the Western central banks, that the consumer preference may be changing. We want more online, we want more digital. And so you have to make this available so not other people outside the banking sectors are starting to offer a solution, and that needs to be rectified later on. I think that's quite important, that sometimes you have to, even with States for Digital, you take a stance, you say, I have a vision, I need to develop and offer services. And now directionally which way I go, but all the details still need to be worked out. And I think for me that's very important, that we don't make that same mistake, being too late with digital payment solutions. For instance, in Europe, and then other people, tech companies, making an offer that would be more appealing.
Yeah, I think you raise a good point. So many things are changing, and we are talking about digitalization of banking. Do you see bank becoming like big tech company?
Yeah, banking has always been heavily driven by technology. So in that sense, it is, there's nothing new about what's happening right now. What I think particularly with blockchain is changing a little bit. At least today, I could very well say, well, here's my data center, here's my data I own, here are my rules, and I have my own walled garden. And if we want to really work with blockchain in a real profound way, or we're going to apply DeFi, then we all ultimately move towards something more of like a shared back office where, what's mine, what's yours becomes less clear, where we're also changing a little bit our roles. For instance, about data oracle, somebody has to, if we have smart contracts that, for instance, would automatically compensate interest, then somebody has to provide the necessary beneficiary data, for instance, tax status, because you just can't pay anyone, a certain amount. You also have to factor in whether you have to make any tax deduction. So that information has to be fed into a blockchain. And if I'm operating on a blockchain, I have to rely on the correctness to some extent of that data. And so for me, that's really changing, where we have to develop new IT governance policies that deal with that different way of exposure, where suddenly I'm relying on external people that I have less control over and that are operating as part of your network and are just bound by code, but they are not necessarily bound by us being subject to the same rule book. And then that's something that forces us to be a bit more like a tech company over time. So from that perspective, yes. But otherwise, I would say, we've always had a need to automate and run, large volume transaction volumes. So in that sense, I think the need for technologies is nothing new.
I think one of the points that it really interests me is this aspect of composability in the DeFi space that could be quite innovative for a bank, giving the ability to create kind of products and services that were not able to happen before.
Yeah. No, absolutely. But think about what we have been doing. So we've been for some time looking at our front to back strategy. So that's you look from front office, middle office, back office, and have a consistent framework. And through our Charles River OMS system, you expose multiple services that can be produced by State Street, but also could be produced by other vendors. For instance, on the derivative space, where if you have a portfolio, you will need to assess, initial margin requirements. We provide services, but the calculation would not be done by us; would be done by different people. So I think that's absolutely, particularly in the institutional space, a trend that's really coming. That you provide an orchestration layer to say you can access it, you get consistent data out of it, but then you have multiple people behind the background that's producing it, and they may be outside to State Street. So I think that's, I fully agree, that is a very important aspect to DeFi, but you, as a bank, you have to be conscious and intentional to enable that. And I would say we really try to make that possible, where there is a customer benefit from it.
Okay. So now I just would like to get your comment on one of the biggest things that's been happening over the last few months, and is El Salvador making Bitcoin a legal tender. And obviously there are other countries that are going to follow. How do you see that evolving? I mean, what I'm trying to understand is Bitcoin, in your view, is going to become more and more adopted. And also I would like to see your take on that kind of like a big news.
Yeah. So talking to clients, I hear both. There's a number of large asset managers who think there's merit to investments in crypto, but there also there's an equally strong group who says it's almost an uninvestable asset, and that really depends a little bit on your philosophy in terms of, can you value it, are these prices robust, reliable, etc. And so, for instance, where we see more interest is on the asset owner side, endowment funds, these kind of organizations, which are a bit more entrepreneurial in that sense, versus, for instance, a pension fund probably being less likely to invest in crypto, because they like assets that are predictable, they have long-term liabilities, and that there's a different investment pattern to that. And whether that's going to change anytime soon, I don't know. So for me, I'm usually trying to stay away of it's a fun debate, but is Bitcoin investable asset, yes or no? That's really for the portfolio manager to do. But it's a use case to learn from in terms of, we've seen certain type of investors, or endowment funds for me is a good example. You know, a lot of the money like they hold for, you know, US universities, for instance, in the traditional, or like in the past, they got donations from former students in the form of cash, but now they actually receive funds in the form of crypto because, you know, younger people, that's where they make their money. And so that creates a need to either hold these assets or sell them, etc. So it's a gradual process where you don't really have to decide. So certain people are exposed to this earlier on than others. But there is I think, a long-term question around whether the crypto market really can evolve and be less Bitcoin dominant. So that's still, I would say, an issue that we've seen this all the time, that if people make these investments, they may have 2-3 altcoins in their portfolio, and that's it. And that's, if you compare this to the thousands of assets you could buy in the other markets from a diversification perspective, I think there's an issue. So in that sense, we need a few more Bitcoins, I think, to make this a truly institutional market.
But I think we do need, you mentioned volatility as a big problem. And nowadays, the Bitcoin is dictating the crypto market. And I think ideally we want to get to a space where Bitcoin is not influencing so much everything else. You know, perhaps Ethereum can stay up, even if Bitcoin is going down. And maybe each of these assets has got different kind of function, because I can't see like a future where everything can become store of value. Something maybe is maybe more specialized into some kind of aspect or application, and something else is going to emerge as well, because there are many other coins like Cardano, Polkadot. They are quite strong projects. So yeah, maybe we need to give it a few years. So all this movement of cryptocurrency and is obviously democratizing finance to kind of fight the digital divide, increasing financial inclusion. Do you agree with that? And do you see that being positive things happening?
It's an interesting aspect. So, we also mentioned CBDC earlier. And again, every central bank who thinks about CBDC, it's always one of 3 things they are trying to do. And besides efficiency, etc., is financial inclusion. So it is always mentioned as one of the main factors. When you look at crypto at the moment, obviously we're dealing with institutional investors, so financial inclusion is probably less of an issue in that aspect. But what we have seen now lately is, particularly in the Middle East and in APAC, is some asset managers trying to explore how digital assets could drive financial inclusion in a better way. But it's then less so about just holding crypto on your wallet. It's really looking at the programmability of the assets, and can we, for instance, micro credits, etc. Could you all facilitate this more cost effectively through a blockchain environment? So I think from that perspective, there's more to come, particularly in markets where people may not have a bank, but they have a mobile phone, so they could service themselves. I would say we are not directly as an organization in the forefront of that, simply because of the function of our product, because we don't deal so much with retail investors in our service offering. But I would say it's something to think about, and maybe for the institution space, it's not as much about financial inclusion, but more about the self-serving or self-custody even of certain financial assets, and giving investors a greater level of control. And that's something that we're definitely seeing happening right now.
So Bitcoin, digital gold, do you see this to be a pattern or within your clients, or you think that they are still quite different?
It's one of the areas, one of the hypotheses. We have actually a team called State Street Associates, and they recently published a paper with MIT on the diversification benefit of crypto to assets. And they looked at short-term, long-term horizon, etc., and really were like, is it a good idea to add a little bit of crypto to your account in a way that you would do with, as you said, digital gold. What they said really is kind of, particularly in the long run, you need for crypto to have a beneficial diversification impact, you need to have a growth of at least 30% or so per annum in crypto. So in a way, because crypto has outperformed the market so strongly, that supersedes some of the downsides of the investments. And so I think that's why, again, with a high volatility and gold, so does this really go together? So in the moment, I would say the conclusion for me to all of this is, in other asset classes, equities, fixed income, derivatives, we have over the years established formulas. It's very easy between State Street and another bank to agree on how do I value a portfolio of bonds. How would you value a crypto portfolio? That is a real issue. And I mentioned earlier, we're providing administration services for crypto funds, and so we have to source market prices, and there are multiple ways where people just take averages from certain exchanges. Sometimes it's weighted by the trading volume, etc. But this is still an issue that matters, and also matters to regulators. So when it comes to the approval for crypto ETFs in the US, that is one of the key prize. How can I, as a regulator, be comfortable that the price formation process in crypto is robust, can't be manipulated, can be supervised? And that is still to be tested. And then I think people take different views what is acceptable at the moment in that particular asset class.
Okay, so basically the takeaway I have is kind of like State Street very much open-minded to see what's happening, around it in the technology space, but very cautious at the same time in making the right step forward, serving the clients in the best way without jumping on taking a position too quickly into something that is unknown. Am I getting the right way?
Well, what I'm trying to say is really, State Street Digital is not about Bitcoin. State Street Digital is about digital assets. And Bitcoin happened to be a big prominent use case right now, but hopefully it's not the last. As a custodian, you never really want to get in the middle of the, what's a good investment to invest in. So what I'm saying is this is very important. We have to provide services where we manage our offering, we provide thought leadership to our clients, and we also keeping an eye on, if you want, the changing regulatory landscape. And that with crypto is, there's a high level of uncertainty. And so we have to take this into consideration. So when it comes to, are we building digital asset trading, digital asset custody solutions, are we looking at all of these kind of aspects? Yes, we do. And they may be useful for crypto, but they may also be useful for security tokens and other asset classes. I'm always trying not to have a Bitcoin discussion. I'm trying to have a digital asset discussion.
I think in a way you also get a great feedback from your clients, because if they are demanding changes, they are demanding different kind of product, then that's where you might have to find something to serve them better. I mean, it's like this kind of business where you are dealing with clients, they kind of push you to be more innovative, is also quite a good mix.
Yeah, no, I mean, I personally take great inspiration from feedback we're getting from clients. So absolutely, you in terms of, if you're trying to develop the services of the future, the voice of the customer is always important. I would say, obviously, in that digital asset space, in many ways, the market is very nascent, just developing. So there's no good data in terms of how you can interrogate your proposal. But we've learned a lot in terms of some of the, for instance, crypto admin services we launched, where as our clients presented us an opportunity, we had to put a service model together relatively quickly. And there was a lot of learning, I think, from both sides, how that could be structured. And then luckily we were able to launch that. So that these are, I think, the good examples that is really, you mentioned this at the beginning of our conversation in terms of how these technologies are changing our services. They're changing it in many ways, but in terms of culture, talent, oh my God, you have to really bring a different mindset. You have to move faster, more agile. We always strive to be, but in digital assets, the pace of the markets is just faster than in other areas.
It is great, because one of the questions that I was meant to ask you was about the culture of State Street. So is there anything else that you want to add?
No, I just want to say this is equally important to the whole new form and to the success, that culture and talent will be a key ingredients, because we have to deliver on innovation, and that's basically what's in your heart and your brain, and bring the right people together. Plus, everything is more driven now by computer science and more, the kind of back office types of activities becoming more prominent in that process. So yes, this is one of the areas that we really put a lot of emphasis on, getting the right mix of talent into that organization that really have experience in crypto, that have experience in blockchain, but also have experience in financial markets and custody. And obviously that's a very rare breed of person who sort of knows the old and knows the new very well. But we need to find these people, we need to train them in order to be successful in that space. Okay, Sven, thank you so much for coming on the show and sharing your insight. It was really interesting chat. Thank you very much. Really a big pleasure. Thank you. Okay, so we have learned quite a lot today on how a bank is trying to be at the forefront of innovation and trying to serve the clients in the best way, having innovation as a catalyst of all these cool things that can be done to enhance services and products. Obviously, the space is very new, is something that is changing continuously, is very volatile, so step has to be made, very carefully in any direction. But it is very interesting to see, banks like State Street changing and being the pioneer in this new tech banking space. So we will see what is going to happen. In the meantime, if you're not subscribed to our YouTube channel, please click the subscribe button and follow us on social media to stay up to date with our news and interviews. And I will see you next time.